Gold just hit record highs again, and the reaction is always the same. Wait, why now? It's not magic, and it's not random. It's basically a scoreboard of fear, policy, and trust. In early 2026, gold pushed up toward the $5,000 level, with multiple days printing fresh records. The jump lined up with a shaky US dollar week, and strength across other precious metals too. So today, we're doing three things. What caused the record high move, who wins when gold rips like this, and what to watch next. By the end, you'll be able to explain the whole story in one breath. Start with the simplest rule. Gold loves uncertainty. Not the I'm nervous kind. The I don't trust what happens next kind. When policy gets unpredictable, gold becomes the quiet place to park value. One of the biggest triggers has been geopolitical shock. When headlines hint at conflict or sudden escalation, investors lean into assets that don't depend on a single government's promise. That safe haven bid is basically gold's superpower. But this rally wasn't only fear buying, it also had a boring, powerful driver: interest rates. When markets expect rate cuts, real yields tend to fall, and gold looks less expensive to hold. Gold doesn't pay interest, so it competes with cash and bonds. When bonds pay less, the opportunity cost of holding gold drops, and gold gets a tailwind. That's the quiet math behind the hype. Now add the dollar. Gold is priced globally in US dollars, so when the dollar weakens, gold often looks cheaper to the rest of the world, and demand rises. Recently, analysts linked gold's surge to a dollar sell-off driven by policy uncertainty. And yes, inflation expectations still matter, even when inflation itself cools. If people feel prices might jump again, or that policymakers are behind, gold can act like emotional insurance. It's not always rational, but markets don't require feelings to be rational. There's another driver that doesn't get enough attention: central banks. The World Gold Council has reported elevated central bank buying continuing into late 2025, with net purchases still strong year to date. Why do central banks buy? Because reserves are about survival, not vibes. And reporting has pointed to gold as a major beneficiary of diversification away from the dollar. Then come the flows from investors. Reuters reported that gold set record highs repeatedly in 2025, while physically backed gold ETFs saw huge inflows and rising holdings. When that demand is steady, it can keep the market bid even on quiet days. So, what caused the record high move? It's the combo meal: geopolitics plus rate cut expectations plus a weaker dollar, with central banks and ETF demand underneath. When those align, gold doesn't tiptoe, it runs. Now, who wins when gold hits records? The obvious winners are people who already own gold or gold funds or gold-linked exposure. If you bought earlier, your purchasing power just improved relative to cash. That's the cleanest win. The next winners are gold miners, especially the efficient ones. When the gold price rises faster than costs, margins can expand fast. Investors tend to reward producers that can turn higher prices into real cash flow. There are also quiet winners in the middle of the supply chain. Refiners, recyclers, and bullion dealers often see higher activity when prices move and attention spikes. Even if volumes vary, volatility brings business. Then there are countries and institutions holding large reserves. If a central bank has been accumulating, a rally like this makes that policy look smart on paper. It can also boost confidence, because reserves are a stability signal. But not everyone wins. People who rush in late often buy protection at the most expensive moment. If you buy gold in a panic, you're basically paying the market's stress tax. Jewelry can be a loser in the short run. When prices jump, some buyers step back, and demand can soften in places where jewelry is a big part of consumption. Gold is cultural and emotional, but budgets still tap out. Some businesses also feel the squeeze. Gold is used in certain electronics and specialized manufacturing, so higher prices can push up costs. It's not always headline-worthy, but it can be painful. So what's next? People want a single number and a single date, but markets don't work that way. Instead, think in scenarios. 3 paths, depending on rates, the dollar, and risk sentiment. Scenario 1 is the supportive glide. Rates drift lower, the dollar stays soft, and the world stays edgy. The World Gold Council's outlook argues that mix can keep gold supported, with upside depending on how deep rate cuts go. Scenario 2 is the risk-off shock. Something breaks, confidence drops, and gold spikes fast. That's when you see dramatic forecasts, because fear compresses time. Scenario 3 is the cool down. If real yields rise and risk appetite returns, gold can stall or pull back. The story flips from "I need insurance" to "I want returns." So what should you watch? First, the US dollar and longer-term bond yields, because those are gold's daily dance partners. Second, central bank purchase data, because that's slow, heavy demand that doesn't care about the mood of the week. Third, ETF flows, because they show whether regular investors are adding protection or taking profits. Reuters highlighted ETF inflows and higher holdings as gold approached fresh records. Fourth, positioning and sentiment. When everyone is already bullish, gold can get fragile because there's nobody left to buy. When skepticism is high, rallies can last longer because every dip pulls in new demand. And here's the mindset that makes it all click. Gold isn't only an inflation hedge, and it isn't only a crisis hedge. It's a trust hedge. When trust cracks, gold wakes up. So record high gold is telling you something. It's saying investors are paying for insurance, central banks keep diversifying, and policy uncertainty is being priced in. That doesn't guarantee a straight lineup, but it explains why buyers keep showing up. One quick note. This isn't personal financial advice. Think of gold like a tool, useful in a kit, dangerous if you swing it like a weapon. The smartest approach is usually sizing and patience, not chasing headlines. If you're watching gold now, watch your own behavior too. Are you curious and calm, or are you feeling FOMO? In markets, that emotional difference is often the difference between a smart hedge and an expensive mistake. Hit the like button if this made the move feel clear, and subscribe for more breakdowns that connect the dots. You're ahead of most people just by learning the why, not just watching the price. See you in the next video.